Investing. Everyone's talking about it. It's the key to growing your money, right? But the stock market can feel like a roller coaster. Up one day, down the next. Scary. That's where dollar cost averaging, or DCA, comes in. It's like a magic trick for taking the fear out of investing. Remember, this is for educational purposes only. I'm not your financial advisor.
DCA is simple. Instead of investing a big chunk of money all at once, you invest smaller amounts regularly. Think of it like putting gas in your car. You don't wait until it's completely empty, do you? No, you fill it up a little bit at a time. DCA is the same idea, but for your investments.
Let's say you want to invest in Susie's smoothie stand. You could buy all the shares you can afford right now. But what if the price drops next week? With DCA, you buy a little bit every month. Some months the price will be high. Some months it will be low. Over time, it averages out.
The stock market goes up and down. It's normal, but these ups and downs can be scary. DCA helps you ride out the roller coaster. When prices are down, you buy more shares. When prices are up, you buy fewer shares. This helps reduce the impact of market volatility.
Section 5. Taming your inner stock market guru. Investing in the stock market can be a daunting task, especially when you're constantly bombarded with news about market highs and lows. It's easy to feel overwhelmed and stressed out when trying to time the market perfectly. We all want to buy low and sell high, right? The idea of making a quick profit is enticing, but the reality is that predicting market movements is incredibly challenging. Even seasoned investors struggle with it, but trying to time the market is nearly impossible. The market is influenced by countless factors, many of which are unpredictable. Economic indicators, political events, and even natural disasters can cause sudden market shifts. Dollar cost averaging takes the guesswork out of investing. Instead of trying to predict the perfect time to buy or sell, you invest a fixed amount of money at regular intervals, regardless of the market's performance. You don't need to be a stock market guru. With dollar cost averaging, you can simplify your investment strategy and reduce the stress associated with market fluctuations. It's a technique that allows you to invest consistently over time. Just set up a regular investment schedule and let DCA do its thing. By investing the same amount of money at regular intervals, you buy more shares when prices are low and fewer shares when prices are high. This helps to average out the cost of your investments over time. It simplifies the process and helps you stay disciplined. Consistency is key when it comes to investing, and dollar cost averaging encourages you to stick to your investment plan regardless of market conditions. Trust in the system and let it work for you. Over time, this disciplined approach can lead to steady growth in your investment portfolio. By removing the emotional aspect of investing, you can focus on your long-term financial goals and build wealth gradually. Remember, the stock market is a long-term game. While there will always be ups and downs, staying committed to your investment strategy and practicing dollar cost averaging can help you navigate the market's volatility with confidence. So, take a deep breath, set up your regular investment schedule, and let dollar cost averaging guide you on your journey to financial success. You don't need to be a stock market guru to achieve your investment goals. With patience, discipline, and a sound strategy, you can tame your inner stock market guru and build a secure financial future. Section 6, DCA's not-so-secret weapon, consistency. Consistency is the bedrock of successful investing, especially when it comes to dollar cost averaging, or DCA. This strategy relies heavily on the principle of making regular, systematic investments over time, regardless of market conditions. The key to dollar cost averaging is consistency. Just like those dedicated gym goers who show up day after day, rain or shine, you need to be disciplined in your investment approach. It's not about timing the market perfectly, but about being consistent with your contributions. You have to stick with it, even when the market is down. Market downturns can be intimidating, but they are a natural part of the economic cycle. By staying the course and continuing to invest regularly, you can take advantage of lower prices and accumulate more shares. It's like going to the gym. You don't see immediate results after one workout, and similarly, you won't see immediate returns after one investment. The process requires patience and persistence. You won't see results overnight. Just as it takes time to build muscle and improve fitness, it takes time for your investments to grow. The market will have its ups and downs, but your consistent contributions will help smooth out the volatility over the long term. But if you keep showing up and putting in the work, you'll eventually reach your goals. The same principle applies to investing. By regularly investing a fixed amount, you can take advantage of the power of compounding, where your earnings generate even more earnings over time. Young investor. Yeah, it's all about staying committed. Commitment is crucial. It's easy to get discouraged during market downturns or when you don't see immediate results, but staying committed to your investment plan is what will ultimately lead to success. Over time, those small regular investments can really add up. Think of it as planting seeds. Each investment is a seed that, with time and care, will grow into a bountiful harvest. The key is to keep planting those seeds consistently, regardless of the weather. History has shown that markets tend to rise over the long term. By consistently investing, you position yourself to benefit from this long-term growth. It's not about making a single large investment at the perfect time, but about making many small investments over time. Regularly reviewing your portfolio and staying informed about market trends can help you stay on track. However, the most important thing is to stick to your plan and keep investing consistently. Whether you're a seasoned investor or just starting out, the principle of consistency can help you achieve your financial goals. It's a simple yet powerful strategy that can make a significant difference in your investment journey. So remember, consistency is key. Keep investing regularly, stay committed, and over time, you'll see the fruits of your labor. Just like those dedicated gym goers who achieve their fitness goals, you too can achieve your financial goals with consistent effort and discipline. Patience, my friend, patience. Dollar cost averaging isn't perfect. It requires a certain level of discipline and a long-term perspective. You see, the idea behind dollar cost averaging, or DCA, is to invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. This means you won't be putting all your money into the market at once, which can be both a blessing and a curse. Because your money isn't all invested right away, you might miss out on some potential gains if the market goes straight up. Imagine the market is on a steady rise, and you only have a portion of your funds invested. You could feel like you're missing out on those potential gains. This can be frustrating, especially when you see others who might have invested a lump sum reaping the benefits of a bullish market. But remember, trying to time the market is dangerous. The market is unpredictable, and even the most seasoned investors can't consistently predict its movements. Trying to time the market can lead to emotional decision-making, which often results in buying high and selling low. This is where DCA shines, as it removes the emotional aspect of investing and promotes a disciplined approach. DCA is a long-term strategy. It's designed to help you navigate the market's volatility by spreading your investments over time. This way, you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your average cost per share. Over the long run, this can smooth out the highs and lows of the market, making your investment journey less stressful. It's not a get-rich-quick scheme. Financial advisor, absolutely. DCA is about building wealth gradually and steadily. It's about having a plan and sticking to it, even when the market gets rocky. This approach requires patience and a long-term view, but it can be incredibly rewarding. It's about being patient and sticking to your plan. Think of it as planting a tree. You don't expect it to grow overnight. You water it, give it sunlight, and over time, it grows into a strong, sturdy tree. Similarly, with DCA, you're nurturing your investments, allowing them to grow steadily over time. In the long run, this approach can help you build wealth steadily and safely. By consistently investing, you take advantage of the power of compounding, where your returns generate their own returns. This can lead to significant growth over time, even if the market experiences short-term fluctuations. So remember, patience is key. Stick to your plan and let time work its magic on your investments. Section 8. Time, your best friend in the DCA game.
Dollar cost averaging works best over longer periods. The more time you have, the more opportunity for your investments to grow. Think of it like planting a tree. It takes time for a small sapling to grow into a strong, tall tree.
Lump sum, which one wins?
There's no right answer when it comes to dollar cost averaging versus lump sum investing. It depends on your individual circumstances and risk tolerance. But for many people, DCA is a great option because it reduces risk and makes investing less intimidating.
Section 10, DCA, not a crystal ball, but a powerful tool.
Dollar cost averaging isn't a guarantee of riches. No investment strategy is. But it's a powerful tool that can help you build wealth over time. Remember, investing always involves risk. Do your research and consider speaking with a financial advisor.
Section 11, ready to dive into investing.
So there you have it. DCA, the secret to stress-free investing. Give this video a thumbs up if you found it helpful and subscribe to my channel for more financial tips and tricks.